Hello and welcome to the End of the Chain. I'm your host, Samuel McCullough, and I want to welcome you to this episode. This episode, I am joined by Chuck Pettid, the principal from Republic. And Republic is a crowd-sharing platform that I've actually invested into a couple of things. It is very cool, actually, because they do an amazing job of presenting companies, doing syndication, and really just building a crowdfunding platform for the future. There are a lot of other sites that allow you to pre-buy products by supporting companies that raise money, but when you invest in Republic, you're actually buying equity in companies, or maybe debt as well too as other options, but mainly it's equity. So it uses Reg CF, which allows both accredited and non-accredited investors to invest into startup companies, which is very cool. I would recommend that you check it out. I use it myself, and I like it a lot. So in this chat, we talk about what's going on in the world at the moment, what is on the horizon for all these startups that are trying to get off the ground when COVID is going around, and just a lot more. So I hope you like it. Make sure to come and check out the Gitcoin grants. I've given a few donations already. I love Tornado Cash and 1inch and a few other projects. My podcast is on there. The End of the Chain is on there right now. So come and leave a die. It's quadratic. So the more people that come, the more grants that are given out. So come check it out. Support Gitcoin, and let's hop into the episode. Welcome, Chuck, to the podcast. It's really fitting, actually, that you're on now, because we just hit the top of the market. We've come to the end of a 12-year bull run, right? From the bottom in 2008 until now. And during that time, there's been many unicorns which have emerged out of both Silicon Valley and China and New York as well too. And it really seemed in the past, especially in the past 2 to 3 years, that there was just huge amounts of money rolling around with SoftBank and them trying to raise their second fund. And I think it's fitting that you're here, like I said, to kind of see what's next with startups, right? And
right.
So welcome to the show.
Yeah, thanks for having me on. Interesting times for sure, and happy to kind of give you my perspective of what's happening at Republic. Kind of give a little bit of I think it's important to visit history too.
Yeah,
you mentioned there's a lot of money out there moving around, and a lot of companies are becoming unicorns, etc. I think a lot of people, and this isn't a knock against anyone in this industry, kind of they get caught up in the the story of people raising big bucks, not having to try hard to do it, and those are the ones that end up in Forbes, Entrepreneur Magazine, and I think that's really happening to everyone. There was a time, I'd say roughly, from 2007 to 10, 6 to 12, somewhere in at that time, when if you went to Berkeley or Stanford and were a Caucasian or Asian founder, you could probably raise capital very easily. That was maybe the only time in the history of venture capital that I can think of that was extremely easy to raise venture capital. And you also got it at really high valuations, and you were given, all the chance in the world to make things actually happen.
But Chuck, how old are you?
41.
Okay, so you weren't around for .com boom, then, were you?
Yep. So I started at Merrill Lynch in 1999.
Yeah.
And so caught the tail end of it. I was definitely involved, I guess, investment-wise in my college days. So 96, 97.
So you think that the money was easier to raise in that 2007 to 10 period than 99?
Similar story, I guess, but probably back then too. But what I'm trying to get at is that, and the way you had asked the question earlier, or proposed the question, is easy money gone? I think it's already come and gone a few different times, and it may come and go again this time as well. But That really, it's a shakedown. It's kind of like, when there's a fire in the forest and all the underbrush burns up, and then the rest of the people, the rest of the plants start growing really quickly.
Yeah.
Something like that could happen here. And we'll start to see companies who are, who have the ability to execute, who have the wherewithal, who have the resourcefulness. And they may not be the ones that are, raising capital easily either, and never have been able to. But those companies are still going to be coming up, and they'll still be, succeeding and being successful and having actual exits and making return on investment for investors. This is a very long-winded way of getting to, yeah, it's pretty weird right now, but it's also not the end of the industry.
Yeah,
which is kind of what I was feeling like the question might be indicating. But
no, I'm not saying into the industry. I'm just saying that the kind of general, valuations really got out of control in the last decade, and we kind of hit peak that in with WeWork and Chewy and some of the other ones that I guess SoftBank's the example that everybody runs to, just chucking money at the wall to see what works, right?
Yep.
But I guess that with Republic, right, you guys are addressing a different stage, right? Where if SoftBank is going after these B's and C's and D's and E's and F or however many letters,
yeah, exactly.
Yeah.
Which is where I think a lot of the bulk of the information, the data is coming from. Like people see, startup capital was in 2018 around, whatever, $20 billion was invested. The bulk of that's going into Series D, E, F, etc. Companies that are right about to go IPO. And then for us at Republic, we typically on the Reg CF platform, like republic.co, that business unit focuses on anywhere from pre-seed to Series A. We also have another business unit that focuses on Series D and later. And that one's specifically for accredited investors. A lot of times, if a SoftBank or an A16Z or a Sequoia invest in the company, we have a pretty good network with founders and they want to work with us, and they're raising $300 million. So they end up giving us a $20 million allocation of that $300 million. And we raise that from our accredited network. On the regulation crowdfunding, portal, that's from anyone in the world, regardless of their wealth. So they can be accredited or non-accredited.
Yeah.
A lot of times when companies are in that later stage and raising that much money, their board mandate is only do this and stick to this plan. They don't have time or resources to actually do a crowdfunding campaign. Why a lot of the times you end up seeing earlier stage companies in the crowdfunding space.
Yeah, I mean the early stage investors are extremely important, right? And it's not so much about the money; it's more about the structure and the connections that they help out with. I just came from another startup that didn't work out, and we raised a couple of rounds, and it just, I don't know. Businesses fail, right? Obviously, but I think the one thing that we lacked was a better structure of oversight, where we didn't have the investor support to kind of carry us along, which I think is one thing that you guys have actually built at Republic, right? By standardizing the process that people are going through.
Yeah, for sure. And on the investor part of it too, like when you end up with, which is not uncommon, 2,000-3,000 or more investors. And we were super conscious. We were past founders, investors, and everything in the startup ecosystem ourselves. We understood that could cause, operational burdens, and you don't need to have that many people in your hair. So we've built tools and organized it for founders so they can actually leverage that, what ends up being a small army of supporters. If they need marketing expertise or they need business development or introductions, we've built post-campaign products that allow founders to take advantage of that network, because that network and that investor base, the majority of them really want to help. It didn't matter if they invested $20 or $20,000. They are, they're providing real value.
Right.
They're providing real access. They're creating business and new partnerships and new sales for the companies that they invest in. and not just like, here and there kind of thing. We consistently see companies that are, generating hundreds of thousands, sometimes millions of dollars in new revenue just from that group of people who invested, because they're sitting in the positions at their own company, or they have their own, or they're in position at, a local, government office where they need to utilize a product or service that company specifically is making. And they're opening the door for those founders because they're an investor and they want to see them succeed. And then those founders, if they're able to, showcase themselves and make the sale, are getting it.
Yeah.
So it's been really powerful to see people on every level helping their portfolio companies. And that actually creates a situation where, and part of the reason why, 72% of the companies that have raised on Republic have gone on to raise institutional funds, venture capital, corporate finance, corporate investments, angel groups, you name it. So accredited investors. And that's because they can point back to that crowd and say, look, I had 2,000 people invest. They left thousands of comments about how great they think my product or service is. That's validation. And then they can go on with their story and say, not only did they just love me for what we're doing, but they've brought us new business, new partnerships. They've gotten us into places that we never would have been able to. You get it's a network effect. They're able to cast their net wider than they ever could, and much sooner than they ever could, because people peppered throughout the country and the world who are trying to help. And it's just up to them to filter it. Mm-hmm. And we do a lot of the filtering for them with our tools. And then they have to take advantage of it.
Yeah, exactly. I mean, if you have 2,000 people who want to see you succeed, I mean, that's a huge base that you can, if you have a problem or if you have anything else, you can just, kind of put it out there. Or people come to you and say, hey, I know this person, or hey, I think you should speak to this company or that company.
Right. And the one that we can't measure mm-hmm. is the people who invest that tell other people about it.
Yeah.
It's difficult to say this individual got 500 people to buy the product. I know it's happening at some level. It's just hard to say exactly what it is. And the founders themselves don't know either, but certainly helping companies grow without a doubt.
Yeah, exactly. I find that I'm the company that I'm at now. I mean, I really see the difference in that if you have one or two persons who are inside the company or kind of outside the company supporting you and have a really loud voice within the community that you're in.
Right.
That I think that matters more than anything else. Right.
We see that on raises. So we can have companies just, going along, it's kind of, campaign raise as usual. And then all of a sudden, it doesn't need to be a celebrity or an influencer or, someone who has a massive blog following or whatever it is. It just takes that one person who actually has a couple dozen, maybe 50, engaged believers in them to speak up. And then that sparks a huge fire that sometimes doesn't stop. Mm-hmm. So one, regular Joe saying something in a positive light that has followers can get campaigns really rolling. And then that turns into not only capital that they've raised, but again, the stuff I talked about before, where they're getting business out of it too.
Right. Exactly. New customers, and that you feel they're really a part of the business. I think that's one thing that's really been, I mean, you look at the other, the other fundraising platforms, they didn't really give that. I mean, you get a product or you get something else, but you're not really a member of the company, right? Or an owner of the company. And
you're a stakeholder, you're limited to, voting rights, information rights. The reality is, as an angel investor, I've done it since 2005. I get portfolio companies that don't tell me anything forever. They don't respond to my messages. I get others who send quarterly reports as much as they can. Sometimes they skip a quarter or two in a row. I've been on boards, and it's really not that big a deal. You spend a couple hours here and there, over a quarter, giving advice or fielding questions or guidance and whatnot. But at the end of the day, the most important thing is just, being there if needed and reacting if they do want you, and not getting too tied up in what's going on in the business. I need to know everything that's happening. You still see a lot of people doing that, but as long as they're sending quarterly reports, most of the time that appetite for information is satisfied. So it's really important for companies just to like send a quarterly report at least like, a biannual.
Right.
So people know what's going on. That's really what they want. And that just, it leads to more business. So it's smart. It leads to more business with my own like personal portfolio companies. If they tell me like in a quarterly report, or they just reach out to me individually and say, this is what's going on and this is working well and this is not working well, can you think of anything? I help. If they don't reach out, I don't.
Yeah, exactly. I mean, but that's half the battle, right? Is that, you as a founder or person running a company or working in a company, you need to be able to think about how you can leverage your investor base or your customer base to grow.
No, for sure.
Yeah. So, but
the other thing
think
I like too, like,
yep.
Along this vein is it's interesting that when this started, before it started, there's a lot of stereotypes being developed where people thought the crowd would not be sophisticated enough. They wouldn't be able to understand things. That's completely untrue. From day one, that's been very obvious that it was untrue. One that was, but still a little surprising to me. And I kind of thought maybe it would be the case, but people think that with crowdfunding, it needs to be something that's, consumer product related, something they can touch, something they can have in their home. That's not true at all. So approaching like half of our campaigns since inception, they're B2B or they're SaaS or they're deep tech. They're things that like people really don't, necessarily could even use on a day-to-day basis. But investors are smart and they're looking for, whether again, doing $20 or 100,000 or anything in between, they want a return on investment, and it doesn't matter if it's CPG or something else. So it's good to see that the vast majority of the crowd is looking for a return on investment. They're looking for a return on investment. They're trying to be sophisticated. They're actually asking the right questions and getting the right information and doing the right things with their decision. So that's been cool to see.
So how does that return on investment actually come? Is it through later rounds that they get bought out, or are they getting dividends, or what's actually happening?
It depends on the security. So most Republic campaigns use a simple agreement for future equity. The primary reason, well, it's very investor protective, as much as some people don't think it might be. There's been safes out there that aren't, for sure. The Y Combinator, like one that started it 8 years ago or so, the original one was good. They've adapted it and amended it a few times since to make it even better. We've added no less than, I'd say, 4 dozen different layers to it, with it really specifically being focused on investor protection. And then, but the real thing that makes it viable is it only creates one line item on the cap table. If you're a founder and you have 2,000 people who've invested, you can't have 2,000 people on your cap table. That will handcuff you in future raises. It'll also handcuff you operationally wise, because you'd have to provide tax information or information on voting rights, and just it would be too much access to the founder and team and company by that many people could cause problems. So the SAFE agreement eliminates those operational burdens. And on the flip side, for investors, you're basically freeing up your founder to do what they're supposed to do, which is build that company and get it to exit, while being protected with certain like triggers and activities that the company, companies typically come across as they grow. So yes, on the SAFE, there would need to be a change in control. So either an acquisition or an IPO. And then we've had 2 of those happen, and one IPO'd and one is acquired. At that point, it's really handled by a transfer agent. Transfer agents are required after you run a campaign. You need to have, basically, they're the holders of record. They have all the information about who invested, when, how much, what their, position on the cap table would be once converted, and they get converted automatically at that acquisition or IPO. And then they handle the actual distribution, whether it's cash or stock in another company, to each individual investor. There's also, we've used debt agreements, so people do get paid. In one case, it was I don't know if it was a 3-year or a 5-year agreement, but the founder accelerated payments and paid in less than a year all back all investors plus the interest that they were given, I guess, for the investment. And there's other ones. There's revenue share, and the reason why debt and revenue share work operationally, that stuff is automated, and those individuals don't go on your cap table, so they're not equity stakeholders. It's basically it's fixed income. There's debt, and revenue share automated in the sense that, and again, it's different each scenario, but companies will pick payment plans. Essentially, we'll do it quarterly, we'll do it monthly, we'll do it semi-annually. That also runs through a transfer agent to make sure that every time there is a payment made, that it's allocated accurately to each investor per their pro rata ownership.
Right. So the equity so outside of the revenue shares and the debt structures, which are pretty laid out, most people who are taking the initial equity investments are looking to get bought out later on.
Absolutely. Yeah. There is looking for the company to be bought out. There is the chance that they could trade it in the secondary market.
Right.
Secondary markets have never been liquid enough or robust enough or accessible enough in the startup world. I do believe at some point they will be.
There's shares post, right?
Right. So I was gonna say a company like that, they're starting to get traction. They're starting to actually build that marketplace. It's headed in the right direction for it to become something that's like a normal part of the ecosystem. Yeah. That one's still a little bit exclusive. Mostly it's only deals that 99.9999% of the world has never invested in and never would have been able to invest in. And those guys are, those investors are trading among themselves basically. Like, hey, I had, $1 million worth of Uber, and before Uber IPO'd, I wanted to dump it off on someone else, and there's takers for that. But if you're talking about, your next door neighbor startup and they've sold, shares on a crowdfunding campaign to 2,000 investors, unless they became an Uber, it's pretty illiquid and not going to be sold. There's been some transactions where people have sold it to, others that they know, but it's not a robust enough or liquid enough market for it to actually be viable yet.
Right, and I don't think the securities regulation is caught up yet into this part to allow for easy transfers of smaller companies across investors as well too.
Yeah, there's a whole compliance regulator factor too that we're overlooking.
Right. Like if you're like a sub $10 million company and you're looking to enable trading for your investors, it can be very expensive, and it may just not be something that you would ever pursue, just because of the compliance stuff, like you're saying.
Yeah.
So I guess this, mentioned compliance, like you've seen the implementation of the Jobs Act, and that's actually one of the things that really led to the birth and growth of Republic. What can you say now is lacking on the regulatory side? Like, what sort of things would you like to see added to the Securities Act that would enable your company to grow even more?
Yeah. So I'm not sure if you're aware of the recent SEC release. It was roughly around March 5th or so. It was, called the harmonization release. Basically, for the last 3 years, myself, our CCO, our founder, who was general counsel at AngelList previously, we've been going back and forth to Washington, D.C. to basically lobby the SEC, the National Economic Council, individuals at the White House, anyone at Capitol Hill that has relation or ability to get this thing moving, get these changes made. And roughly around March, say 7th or so, that release came out with the changes that are expected to be made sometime in September of 2020. And we see companies, what it'll be is companies who utilize regulation crowdfunding today are restricted to $1 million maximum investments, $1,070,000. That will go to $5 million. That's probably the most impactful one.
That's pretty big.
That'll open up the doors to what it'll do is it'll drive a lot of companies that typically or had previously looked at regulation crowdfunding and said it wasn't worth their time, and now they'll actually consider it. It'll also take a lot of companies that were doing Reg A raises who weren't going to raise, more than $5 million. But now they can do it through Reg CF, which is a less stringent, easier, less, it's not as expensive to do, and they'll start actually utilizing Reg CF instead of Reg A. Other rule changes revolve around investors and how they're, I guess the amounts that they can invest. So if there's a calculation that's done, was made by the SEC that tells investors how much they can invest per year in regulation crowdfunding campaigns. It's pretty fair, but it gets to a point where it's not fair for wealthier individuals, accredited individuals, even institutional investors like actual funds are topped out at $107,000 per year that they can invest in crowdfunding campaigns.
Wow.
So that will go to the wayside. And if you're an accredited investor or you're a fund that's properly funded, you can invest as much as you want. So like the way it should have been. Basically today, if you're a billionaire and you make $1 billion a year, you could only do $107,000 maximum across all campaigns. And then the peculiarness about the rule, if you're a billionaire and you only made $100 a year in salary, and I know that's impossible because like dividends and interest and all this other stuff, let's say that was the case, the maximum that you could invest per year is $2,000. And that's just the way that the calculation works. It's a factor of assets and income, and then it pumps out a number that you can actually invest.
Yeah. I'm glad they're making the changes. I mean, I remember this past year with Blockstack had done their Reg A, or I think it was Reg A plus offering, and they raised $23 million, but they paid, I think, $4 million in fees, $4.5 million in fees to get to market.
Yep, it was somewhere there.
Yeah.
So we worked closely with Blockstack. We actually helped them on that. They were going to do a Reg CF campaign. We even went as far as filing the Form C, which is the kind of the final document before you're allowed to do a crowdfunding campaign. And then a similar story to these other companies that are later stage or getting mandates from their boards who rightfully so, hey, you need to focus on raising the 20, 50 or 100 million, only do that. And then that didn't happen, but yeah, we've known those guys for a while.
Yeah. Well, I guess it makes sense to raise the cap, right? Because with platforms like Republic that give greater transparency and are providing a lot of the due diligence, I guess the SEC can look at that and say, hey, here we have greater transparency, and we can ensure that investors are getting good deals and not being ripped off or anything, and not being drawn into any potential scams or anything. And they have to worry about it less, and so they can increase the rates at which companies can raise. And I guess the past couple of years since the Reg CF was introduced was kind of a test bed to see how it would work, and it has worked well. I mean, there's a lot of companies that have, or not just companies, but other entities which have used Reg CF to raise money. I know it's not just startups which are trying to do that.
Yeah, brick and mortar for sure. I think. Well, I actually want to take one step back. So,
yeah, sure.
Interesting thing and we got to think about the flip side. So, like a Blockstack, they did not run a regulation crowdfunding campaign. $1 million was not interesting enough to them to do it, but 5 million may have been.
Right.
That right there is really good for investors, because the majority of investors aren't accredited, and they wouldn't be able to get into Blockstack, who did, well, they did Reg A, so I guess people could do it through that, but through the Reg D, through their accredited raise only, they miss out on that. But with it being 5 million, I think you're going to see a lot more viable opportunities coming.
Yeah.
And running regulation crowdfunding campaigns. So it's a really good thing for investors. Part of the reason why the SEC did it is because you would tell them, we have this many companies in our pipeline, that $1 million is just not going to be good enough for them, but they're very viable and they're going to go out and get it elsewhere.
Mm-hmm.
So if you want people to get access to these things, you need to increase the, maximum raise amount. And they did. And now I think that'll lead to better investment opportunities for the crowd at large, which is great.
Exactly. And it also matters a lot for companies that are trying to maximize their, I guess, investor/customer base, right? So for a company like Blockstack, it really matters how many people own the token. You don't want to have just a couple of funds that control, 80% of all the tokens that they're selling. It's in their best interest to be able to distribute as many tokens to as many people as they can, and then stay within the regulatory structures that have been established.
Yeah. Exactly. That's why we made one of our securities is called a token DPA, debt payable by asset. Yeah. It's specifically built to help people like Blockstack and other companies that are using tokens to spread them, to get them around, because more people need to own them, right?
Exactly.
For it to work. And that's exactly what our security did, was get more hands on it, basically.
Right. So was Republic always crypto, pro crypto focus, or did that come later on in 2017 and 18?
It came on around about a year after we launched. So we launched in the summer of 16. Summer of 17 is really when Republic Crypto came to be. We had a couple team members who had been around crypto space for a while at that point, which is unusual. Mm-hmm. And they had a good Rolodex, basically, and we were helping companies raise capital through our Reg CF license. And then there was crypto winter, of course, and that dried up. But what we were left with was, we had a pretty good name in the crypto space. I think a really good name. And we had the expertise in regulatory compliance and legal. We also had tech expertise in the blockchain space on our team. And companies that I would say they're not startups, or more, not even later stage startups. These are companies that have been around 10, 20, 30 plus years, were reaching out to us and saying, we want to deploy blockchain technology in some form across our company. How do we do it? And that's when Republic Crypto really became a consulting practice. Now, Republic Crypto still brings in deal flow, people in that space that are looking to raise capital, whether it's through our broker dealer, through our labs division that is for accredited investors only, or even on the CF platform that I run. But we got into and we still do a lot of consulting work for companies,
right,
who are tokenizing, who are looking to eventually do a security token offering, because we can bring that knowledge and expertise and then that compliance comfort to them and get them to what they actually want. So some of those are coming to fruition. You'll probably start to see some security token offerings in 2020 from our team, with companies that we started working with 2 years ago. And so it's been pretty cool.
But, some of the companies that you work for, I mean, you've really been breaking ground with the, I guess, regulatory structures for crypto companies. You had Pocketful of Quarters, who got the first no action letter from the SEC. Was that an expensive process to push them through to get that letter?
I don't think they spent that much money on it. Yeah. Nothing more than they would have for any type of attorney work when it comes to a regulator. So nothing crazy. The founder's father, he's a venture capitalist, and I think he probably had navigated security regulators before. So it wasn't too surprising. We did have to give them guidance on a few things. We did have to provide a few documents to make sure that they had everything in place. But overall, it went really smooth.
Yeah.
It was not, It wasn't one of those you're just waiting and wondering when you're going to get screwed. It was kind of everything was done that they wanted. What could happen? And then all of a sudden you got the no action letter. So it was good.
Yeah. I mean, that must have been pretty cool when you guys got it.
Yeah, definitely.
Yeah. I mean, so what's in store? I mean, you must have been looking back in 2017 and 18 when, you had all these ICOs just raising in whatever way possible, kind of banging your head against the wall, and things have finally come back around to where pretty much every single company that's going to market now is working through these proper channels now. And so I think it's actually a boon for a company like Republic, where, people are choosing to go the proper routes, even though they may take longer.
It has been. I think, kind of danced around a little bit in this conversation, but with Republic Crypto Consulting practice, with our accredited product, with our retail product, all these things are starting to rev at a pretty serious pace. And the reason why I think the industry is finally starting to accept the tools that we offer them as an everyday part of their toolkit. So they're looking to us, maybe as much, not more yet, but it's getting close, looking to platforms like us for capital raise needs than they are looking at like typical venture capital or typical like institutional funds.
Yeah.
So we're able to, because of the different exemptions that we have, because of the different infrastructure that we've built and team members that, operate and manage those different pieces of the puzzle, we're able to absorb a lot of this inbound basically. And there's a place to put them, a place to work with them on just about everything, because of the way that we set up our business, because of the way that we have these different exemptions, because of all the different like compliance routines that we've gone through with the SEC, with FINRA. And so that makes it a lot easier for companies to work with us too, because we've already like been through the ringer. That leads to assurances with their attorneys, where 4 years ago, attorneys were scared of regulation crowdfunding, let alone crypto or Reg A. They had no idea what that stuff was. Today, they're starting to get it, and they can see a track record from Republic of actually executing on it. So they're more comfortable, and they're more likely to tell their client to move forward. Clients more likely to get approval from their board. All these things that we've been like building and pounding the pavement on for the last 4 years are getting a little, they've got traction. It's a lot easier for us to work with companies, which has been great.
So how does it work for a company who wants to go through Reg CF then?
It's a very simple process. Yeah, I mean, it's a 30-second application process online. Some people still like apply directly to individuals on the team. And then we do a topical review, things look good. Our diligence team will reach out, have a call. After the call, they write a report. That report goes to our investment committee. Myself and a couple other people will sign off on it, yes or no. In the meantime, while that stuff is happening, we're educating them about the entire process, making sure that they understand what it takes to do it. They understand what we do for them. They understand what the costs are. We're hearing from them that they're like fully educated. We're also hearing from them that they want to do it. And then when these stars line up, this only takes about 2 weeks. Get a campaign agreement to them, they sign it, and then they're introduced to our onboarding team. That team, full service. It's not a situation where we just tell you like, here's what you got to do, have fun, we'll see you at the finish line. It's here's what you got to do. We're going to work on these with you first. Once those are done, we'll work on these next ones next. And then you're going to work with this third party. You can use your own or you can use ours, up to you. And these pieces come together, we're going to launch a campaign. And then they work closely with our marketing team on, one of the biggest things we do for companies is, and it's a fun part, we help them create content. And that's through partnerships, whether it's, a podcast, a radio show on WGN, live TV, live events, print media. We even have an in-house in-house ad performance agency. They do that work at no cost to the founder. We'll actually do a few $1,000s for each campaign, kind of show them what we can do. If they like the results, they can give us their capital. They give us $5,000 and that turns into $25,000 in investments. They keep all $25,000. We don't like skim from the top.
Yeah.
Ad agencies typically do. At the end of the day, all these efforts create content as URL that they can share with their network, that we can share with our 500,000 plus, registered investors. And then hopefully they either invest, become a client, or they tell someone else about it. And a lot of the times, the only reason that's happening is because of the service that we provide them in the beginning. We're helping them, make sure they put their best foot forward in their regulatory documents, in their public-facing deal page, in their communications. That increases the chances that people do one of those three things. If they're doing any of those three things, you're winning. If they're doing two or more, you're really winning.
Yeah.
So that's why we spend a lot of time on, servicing and working and actually being a partner. That actually goes back to the diligence part of it too. Yeah, you're looking for fundamentals. You're making sure certain things are in place in order. A lot of it boils down at the end of the day to, is this a person, team? Are these people, going to be partners of ours? Do we want to work with them? And if that's the case and everything's buzzing along and the partnership is, strong, those do better than the other campaigns do.
Yeah. I mean, one thing I like about your site a lot is that it's not just San Fran and New York companies there.
Yeah.
You see companies from all across America being highlighted and able to raise funds through your platform.
Yeah, for sure. So the core of the team came out of AngelList. Well, I guess our two founders did.
Mm-hmm.
And one of the things they wanted to do from the get-go was to serve the underserved founder. And that doesn't mean, just, different folks, I lost the words. Doesn't mean we have to only focus on like African Americans, or we only have to focus on Latinos. It also means people from overlooked parts of the country.
Yeah.
North Dakota, Nebraska, even Nevada, Atlanta, Georgia. So I'm not in like the diligence guy, but honestly, like I'd rather see a company out of Atlanta, Georgia than San Francisco, California, because the Atlanta Georgians to me are hungrier and they're trying harder. They also seem to be more resourceful. If all apples are, everything's the same. So I think, yeah, we've done a good job of being very mindful of that
Mm-hmm.
and helping. And we're trying to push everyone forward, to be honest. If they're like a viable opportunity, we want to work with them. We've done a good job of getting across the line for companies that never would have been, raising capital, never would have had a chance to actually raise from real angels or real venture capitalists. But now they do because they've gone through a Republic campaign. They've gotten that exposure. People really know what they're about. They're winning.
I mean, this kind of goes back to this goes to a theory that I have that like over the next decade, you'll see a greater movement away from San Francisco and New York into other parts of the United States. So like Memphis.
Yeah, no, I believe that theory for sure.
Yeah,
yeah.
Because people have gotten priced out of family creation and living normal lives in San Fran and New York. I mean, it's just impossible to buy a house if you're a 20-year-old. Possible to start a family, and yeah. I think the benefits of moving to one of these smaller cities is, even though there's not the same connections that you might find in San Fran or the same level of like top tier investors that you'd be able to get with. I think the ability to hire people within that local community and then have them live there and start family formation is much more powerful.
It's good for company culture. It's mm-hmm. good for this like work life. I know I lived in New York for 21 years and maybe it's 22, whatever it is, but it can wear on you for sure.
Yeah.
And people should do what they're comfortable with. And if it's living in, like you said, like Memphis, Tennessee or Columbus, Ohio, you can get stuff done there just easy as you can here.
Yeah. I mean, I just moved out of the big city to somewhere super small. It's not small, but I mean, it's suburbs. And I just had a kid and I had to ask my question of, do I want my kid to grow up in the big city? And I said no. But I think it's a really hard question to ask. I know a lot of people move out to the suburbs of New York and to San Fran and stuff, but I don't think it's the same, right? When you can have a big house and have a backyard and let kids run around and feel safe about them.
Yeah, well, it's safe, but it's not cheaper.
Yeah, it's just not cheaper, right?
In some cases, it's more expensive. Yeah,
right. But you can go if you go from like San Francisco, you're making $150,000 a year as a developer or something, and then you transfer to Memphis and you're making, I don't know, 120. You've essentially doubled your income.
Oh, yeah.
Yeah.
Yeah, no, for sure.
So, but it's cool to see that. I mean, I really, am a big, I really love seeing startups that come out of these non-mega cities because they probably have, like you said, really driven founders, and they've really worked hard to get where they are if they can achieve traction, and go toe to toe with the big city boys. Yeah. So, I mean, what do you think's in store? Okay. So I want to go back to the beginning again. So what do you think's in store for the next, year or 2 years? This, the coronavirus marks the top of the market. The aggregate, or it's not aggregate, but nominal demand is just collapsing across the entire globe for the next, who knows how long, right? I know that most of the startups that IPO'd in the past 2-3 years, started in 2008. Uber was started in 2008. Airbnb was started in 2008. So it's really during these, tough recessionary or depressionary times that strong companies are formed, because if you can make it during the worst times, then you're able to grow and do better when money is flowing and the markets start going up. So, I mean, I guess what's your opinion about what's going to be in store for the next year or two?
So I think you're going to see a lot of forced hands, people who are essentially being forced into doing something earlier or in a way that they didn't expect. And it's also going to be sooner than later. And just in the last 4 or 5 days, one of the things that I'm hearing, and it's being reported on our team, and it's coming up pretty consistently, is something along the lines of, I was going to wait until after the summer, or I was going to, time this campaign with a marketing effort that's happening in March, April. I'm going to instead launch now, and I'm going to keep my campaign open longer than I ever anticipated. So people that's a good sign in the sense that people are still, for us, want to move forward, and we'll yet to see how investors react. It's a good sign that people are still seeing this as viable and they want to move forward, and that they want to move forward sooner than later, and that they're actually being realistic about it, and that they would stay open longer than they would typically stay open, for a campaign.
Yeah.
One of the advantages they can take advantage of, and why they're doing this, is they can do rolling closings during a campaign. So you raise 50,000, you can take out 25,000. You raise 100, you can take out 50. You can take out money as the campaign goes. And I think what you'll also see from founders who are actively raising is a little more creativity, whether it's offering sweetheart deals or more incentives to investors to get in now as opposed to later. You probably see others who start to tighten up. They're going to actually, I mentioned people before that don't, provide, updates or communicate or let you know what's going on with their, the business that you're invested in. So you'll start to see people do that more consistently and professionally. So I think this, current crisis is going to make people more focused. It should make them, their professional, the way they conduct themselves professionally is going to be sharper. That type of stuff actually it makes me feel good about what's in store and what's coming. I'm already seeing it. We're only a few days into this, so it's a really great sign that people are starting to, their hands are being forced by it, but they're reacting appropriately, and what will come out at the end is a better, a better product, a better opportunity, a better founder, a better company. So I'm happy about that. That's kind of what I see happening. There is going to be times, and I'll probably see it, definitely in the short term. Hopefully these things don't last until, end of summer or whenever. But there'll be a little bit of a pullback. We've experienced some pullback already in total dollars raised per day. Mm-hmm. But even within that, there are still people who are investing, and they're changing their comments to, I know this company needs this money, more now than ever, and I still believe in what they're doing. I still believe they have an opportunity to be really successful. So it's positive. It's really great to see investors leaving those type of comments, and I think that'll eventually add up. And the total pullback won't be as great as people are fearing it will be in at least private investment land.
Right.
Last thing I'll say too, and I've seen this a few times, I'm not sure if this is the right mentality, but it's popping up. It's popping up daily, if not hourly. There's a lot of chatter from investors, even like gurus and other like financial influencers who are saying private markets might be the way to go because price fluctuations are, it happens less. It's not actually, forward facing. You don't see it on an hourly or minute basis. You don't see it, in the paper every day. You make an investment in a private company, you get it at whatever valuation you get it at. The next time you know if you went up or down is once they run out of that money and they raise again. So it's a little bit more stomachable, especially in like this time. And I think you'll probably see a shift of new investors coming into private investments specifically because they can't stomach what they're going through the last like week or two in American stock markets and world markets.
Yeah.
So those are the couple things that I'm hearing, and just trying to stay, staying positive is going to be super important too. And maybe I'm just like picking out the ones that are really positive, but they've definitely been popping up. And these are things that did not pop up 2 weeks ago. And now they're coming up every day.
Yeah. I mean, I know that, I wish that my toilet paper would come back sooner, but I have a eventual positive outlook. I think that, it's, hopefully it's just a month or two and, we can get it under control and then everything goes back to normal. I know there's a lot of knock-on effects from shutting down a whole economy for a month. But I don't think that's something that we can't work through.
I'm on the same team there. I think it's, there'll be bounce backs. There'll be some sense of normalcy that comes back. There'll definitely be some companies that are broken because of it. The reality is they probably would have been broken in 6 or 12 or 18 months anyway, but forced hands, and we'll see how it folds out, but I'm optimistic.
Well, cool. Chuck, it's probably a great place to wrap things up.
Yeah, for sure.
Thanks for coming on.
Yeah, definitely. I liked it. Hopefully I was making sense. My brain is scattered right now, as you can imagine.
Yeah.
A lot of inbound, not the greatest day for a podcast, but hopefully I shed some light onto what's going on in the startup ecosystem at Republic.
Thanks, Chuck, for coming on. I really enjoyed that. I actually found that chat really interesting. I learned a lot about the upcoming Reg CF changes. Hopefully they come. 5 million is a great number to get to instead of just 1 million. Also, I went immediately after this and I became a Republic customer. I think there's some very cool companies coming on there, and I think it's a very cool platform. So I recommend that you go check it out as well too. I really like it. Thanks for tuning into this episode of The End of Chain. Make sure to support us on Gitcoin and subscribe to the newsletter, and I will see you soon.